Buying company at a good price, it's kind of the goal of every investor that want to outperform the market. But yet, the valuation is something that creates a lot of debates. And also, it's something where I can see so many mistakes from investors, but also from people on YouTube, on Twitter X, that are giving advice, that are talking publicly about all of this. I can see so many valuation mistakes. So the goal in this video is to help you out to figure out all of this and to not make those mistakes, because you can be very surprised if you make them, and it can really deteriorate your performance over the long run. You may think that, oh, now it's fine, I have good performance in the last 2-3 years, so I'm good with valuation. But the problem is the last 2-3 years were exceptional. Everybody had a good performance for the last 2-3 years because they were exceptional. So the goal here is really to have good performance over the long run in different business cycle, because we just knew a good business cycle since the pandemic. So it's what we'll see in this video. So the first common mistake that I see, it's not understanding the business cycle. You have this cycle. Michael Mauboussin writes very good articles, books, and he talks in podcasts about this. So basically, a business has different cycle, and you have infancy, where the project is starting, when something new arrives. Then it goes to expansion, maturity, and then progressively dying. And the valuation is not the same in each part of this cycle. Okay, the valuation metrics, the valuation that you want, the PE ratio that would be a normal, is different in each cycles, okay, in each part of this cycle. And you need as well to know that it's not because the company is here since 50 years that she doesn't have those cycles, okay? A company can have go to maturity, die, and then go back to infancy because they are launching a new product, they are launching something new. For example, Apple, it was a mature company starting to potentially die, and they launched iPhones, okay? Same happened in 2018. It was mature, and then they started a new cycle with more buybacks, with all of this. So it created a new expansion for shareholders. Okay, so really remember that this is not only for a company, and it's not only on 20 years. Like a company can be here in 100 years and go through this cycle multiple times. That's why some companies are better than others, because they are able to start again the cycle and to not die after arriving to maturity. So a company which is in infancy will not be valued the same that in expansion, because there is a lot of uncertainty in infancy. It's generally where you do pre-seed, it's for startups before they get on the stock market. Then they got public, they're generally at the end of infancy or beginning of expansion. Some of them arrive public like in the middle of expansion, eventually at the end of expansion. So you need to try to understand where the company is for this. And generally in expansion, it's where you have high multiple. Okay, it's during the expansion phase that you will have high PE ratio, high price to free cash flow ratio, because it's where you have the most growth for the company. And the problem, the mistakes that a lot of people go, is they think that the growth will continue like this, or they think that this PE ratio is normal for the company because the quality is very good, because the growth is amazing, and so on. So they will take a PE ratio of 30, 40, 50, 60 as the norm for the company, and then they will have some problem, because when the company will arrive to maturity, have less growth, they will realize that, okay, you cannot value a company like this at a PE of 40. 40 is way too high. It's maybe more 20, 25 eventually, because the quality is very good. So this is a mistake that I see a lot, people not taking this into consideration and considering companies that are at the end of the expansion phase, at the beginning of maturity, and valuing them as they were starting the expansion phase or in the middle of expansion phase. So be careful with this. Generally, the value trap, it's at the end of expansion phase. Okay, this is when we have this famous value trap, is when you think that the growth will come back, but no, the growth never come back. So this is the first mistake, and I think it's very important one, a lot you need to be aware of, and you need to take this in consideration when you're doing your valuation models. Mistake number 2 is focusing too much on the past. So it go a bit with the number 1. It's not because a company has historically a PE of 40 that it should always be the case, because maybe now the business got deteriorated. Maybe now the business doesn't have as good debt management as before. Maybe the management is not the same. Maybe the moat is deteriorating. So it's not because historically a company have a high P ratio of 30, 50, 40, whatever, that it should be like this for all the lifespan of the company. So really be careful for this. Mistake number 3 is not comparing the company with peers, okay? You need to look at the competitors. You need to look at what's around, and you want to know, okay, how the competitors are valued. First of all, you want to look at the metrics. Do competitors have better metrics, less good metrics? How is it going with this? And then how are they valued for those metrics, okay, for what they have. If competitors which have pretty similar metrics have a lower valuation, it's either your company has a better growth prospect or your company is overvalued, even if she had a low PE. Okay, maybe you have a company you like with a PE of 15, but competitors with kind of similar metrics have a PE of 10, you may be overvalued. Or maybe it's something that you will not see in the metrics, you have a better moat, you have a better management, and so on. But generally, like maybe your company is overvalued, or the competitors is undervalued, and you estimate that, okay, you have a low PE, so the PE will go a bit higher, and this is where you can get the outperformance. This is where you can get something. So don't just focus on the company because you like the metric, because you like it. Remember to compare with competitors to have a better idea. Okay, it's important to understand where the value is standing for the competition, where it is, because you may have some better opportunities with the competition than with the companies that you are looking at. Mistake number 4, it's okay to have a company which is expensive, but there is a limit, okay? The more expensive a stock is, the more risk you're taking. This is something you really need to understand and accept. You think that, oh yeah, no, this company is always going up, have a magnificent result and so on. So it's not risky. Yes, it's very risky if the valuation metric is high, if the PE is high, because as soon as you will have a bad news or less growth, you will have a PE which is still high, and the stock will go down because, yeah, the sentiment will change. So set a limit, okay? Set a limit always. Personally, when I'm doing my DCF, I never put a PE ratio higher than 30 in my estimate. When I put 30, is really because I love this company, like the company have great numbers, great future and so on. Here, eventually, I will put 30 in my models, but generally, I never go higher than 30 for my valuation metrics, for my valuation models, okay? Mistake number 5 is to not take growth into consideration. Okay, it's normal to pay a premium for a company which have a higher growth. So if you compare two companies and one have a P of 15, the other one have a P of 20, but the one of P of 20 is growing by 15% per year while the other one by 6% per year, like it's normal you pay higher for something growing 15% per year. It's really normal, just you need to be aware of this and to set a limit for this premium. So everything has a price. There is always something too expensive, so really have this limit. I would like to show you an example, for example, of a company which is a bit difficult to value because historically it had a high PE with high growth. It's Arista Network. Okay, if you look at the growth of the company, you have a company growing by 26% per year for the last 10 years, 31% per year for the last 5 years. And in terms of EPS, 44% per year for the last 5 years and 10%, like 39% per year for the last 10 years. Now the estimate is around 20% growth for the future, so it's still great. You can see that now in the expansion phase, they're probably more close to the end of the expansion phase than the beginning, but you still have some good growth prospect for the company. But when you look at the PE ratio, you can see that historically, we'll put it in LTM, so the PE ratio currently is 38. Okay, so if you look at the history of the company, the median is 39, the average 54. So the median is 39, you say, oh, we have 38, so it could be undervalued. Compared to the historic of the company, it could be undervalued. So here, let's eventually take out this big move that we have in 2012. and go only from 2013, or even after 2014, okay? We just go like this. We have a median of 38, an average of 38, so we say like, okay, the value is pretty fair. But you need to take in consideration that this company is growing less fast than it was for the last 10 years. It's a company that have only 20 years, okay? Arista Network is pretty brand new company. So it was in this infantile and expansion business cycle, okay, in the cycle. So it's normal that it had higher growth. It's normal that the P was high. So now you cannot, when you do your valuation model, you cannot expect this company to keep having a PE of 40 because the growth will start to be less good. And it's not because this business is great, like it doesn't have anything to do with this. It's just that it's normal in the cycle of the business. You need also to take into consideration that from 2009-10, the world has a really low interest rate. So it was very easy to do business. It was way easier to do business from 2010 to 2025 than it was probably from 1990s to 2000 or 2010, okay? It was like the interest rate was extremely low for this period. It's been historic that almost every country in the world had low interest rate historically. So we're in an environment where it was normal to have growth like this because a lot of money was here. A lot of money was printed. A lot of money arrived on the market. A lot of business went successful because of this amazing period. So you need to understand that this will not last forever. There is some point where the cycle will go a bit downward, where the cycle will be less aggressive, and you need to understand that this will translate to the earnings of a company. So this is some things that you need to take into consideration when you will do your valuation model. And now that the market is at a P which is pretty high, I don't know exactly the PE, but I think the PE ratio of S&P 500. So yeah, the PE ratio of the S&P 500 is around 27.8. So historically it's high. So when it's historically high, it means that the risk is really big. So you need to take double margin of safety to really not take too much risk with your portfolio, and don't be fooled by high PE and so on. Like really take a lot of consideration, a lot of margin of safety to really have some good valuation when you will do it for a company. For example, with Arista Network, with my valuation model, I will use a PE of 26, which is still pretty high, but more in line with the growth. A growth of 14%, so it's a bit less than what analysts are expecting. I take less because, again, the market is really high, so I want to take good margins of safety. So here, the fair value would be around $68. It's 95 now. As you know, if you follow my video, I missed the opportunity here because the stock went to 59. I didn't buy, I was too greedy. But you have good, it's not because like you are very strict with your valuation model that you will never have an opportunity. Opportunity will come. You just need to be very patient with all of this.